My name is Michael, and on this show, I talk about stocks that are interesting. If you've been watching me for a while, you know that I started public market investing themed videos in November of last year. It is March 10th, 2025, as of the recording of this video. The very first company that I covered was Hershey. Since then, Hershey has had quite the ride, and the markets have had quite the ride. Of course, in the last several quarters, we've had the first several months of the Trump 2.0 presidency. That's created a lot of volatility in the markets, among other things that are going on right now. So, this is going to be the first video on my channel where I revisit a company that I've already talked about, and um, we're going to take a look at their most recent numbers. We're going to take a look at the performance versus the relative market. Is the thesis playing out? Since I made my last video about Hershey stock, I have not sold a share. I have not bought a share. I've continued to hold it. Continues to be one of my larger positions. It's a top 5 position in my portfolio. So, without further ado, let's get into it. First, I want to talk about United States markets right now. Here we're taking a look at Seeking Alpha. This is, you know, the news here. NASDAQ plunges 3%, S&P drops 2%, Dow falls as well as Wall Street sell-off continues. We see here's the performance of U.S. equities year to date. We see just about every index here seeing pretty poor price action. Only the Dow Jones is up year to date. NASDAQ performing pretty poorly. We're still up over the prior 1 year, over the prior 3 years, with the exception of microcaps. Let's take a look at U.S. equity sectors. This is real important. You see here, our indices are red. However, out of all the sectors in U.S. equities, only 2 are red. The remainder being green. In fact, some, such as healthcare, 8.5%. That's interesting. There's a clue there that tells us something that we already knew or should have already known, which is tech dominates the big indices, especially NASDAQ and S&P, but Dow Jones also has tech exposure as well. So I don't have the exact market weights in front of me. However, tech being a major one, we see that's down. The only other one that's down, consumer discretionary. These are 2 sectors that I have very low exposure to. Today, we're talking about Hershey's, the Hershey company. That would be a consumer staple. Although confectionery is a little, it's somewhat discretionary, Hershey is considered a staple. We see, again, here, if we look at the factors, growth is driving the sell-off, given that our indices are top-heavy with growth names. We're seeing a rotation right now, folks. We're seeing a rotation right now from high beta, high growth names, the names that have dominated sector performance or market performance for the last really quite some time now, decade plus. We're seeing those names underperform really versus everything else, with the exception of consumer discretionary. Again, this is a high level view. And then what's interesting is our markets are underperforming are underperforming global markets. In fact, if we look at, here's our, this isn't the extent of markets across the world. It's only 7 countries, but we see out of the 7 countries listed, U.S. markets, otherwise the VTA, the Vanguard Total, U.S. market index down year to date. Other countries notably outperforming, most notably China and Germany. What's driving this is defense names. The talk of us withdrawing out of NATO is really driving a lot of this. If you look at individual defense contractor, based in Europe, you'll see that. I'm not going to go into that in this video. And then, of course, China. I think what China is benefiting from is their their stock market performed terribly the last few years. A lot of economic concerns. They are stimulating their economy right now. Government spending. They're doing the exact opposite of what we're doing. And I do think that there's some rotation, out of our tech stocks, not only into, other sectors, but into global equities. And a lot of that money is ending up in China. So um, that should give you an idea of, if you're a stock picker like I am, you want to outperform the markets. My benchmark is the S&P 500. Okay, that's what I want to outperform. You can choose whatever benchmark you want. The majority of my portfolio is US based. Hershey is not only a US company, but they derive a majority of their sales from the United States. So they very much fit into this bucket of a US equity, both in headquarters and in sales. So let's talk about Hershey. Again, just want to paint a picture for you. This is this is the ETF SPY year to date. Let's just take a look at the S&P 500. This is our S&P 500 year to date. Really, in the last few weeks, there's this isn't really very steep, 5-6% drawdown in our equity markets. But I want to now talk about Hershey, and let's reference the article that I wrote. And yes, for all the viewers out there who are unfamiliar, yes, I write articles. Yes, I write articles on Seeking Alpha. Yes, I refer to them in these videos. I have not referred to them in these videos as of yet because I have not round tripped a video. Again, this is the first time I'm talking about a stock I've covered already. So this article and the video that I made released late November, 5 months ago, almost 5 months ago. We see here the stock has done well relative to the S&P 500. In fact, we've seen over a 10% total return, whereas the index itself down 5%. Now, here's the thing. In January, not so long ago, the call looked like it was not a good call. The stock sold off significantly. It was down almost 30%. Um, you know, I had made my buy call here. All the while, I had been picking up shares. My cost basis is basically where the stock is today, around 190. But the reason that I'm going into this, we'll talk about the thesis, several factors of the thesis. It's a wide moat stock. That's the first element of the thesis. Second element, the company has the largest market share in the US confectionery market. It's wide moat, leading market share. And furthermore, I said, and I quote, second, while candy is somewhat discretionary, its sales are also tied to Halloween and Easter, making confectionery cash flows less cyclical than the broader market. So, in other words, the company is a value stock, a value investment. If you've been watching my videos, you see that what I cover is primarily value oriented investments. The reason being is that we have been in a part of the market cycle where a lot of these value stocks have been at relatively attractive valuations versus tech stocks. We see that playing out now. These are companies that I have in my portfolio. You see here, CRM, that's Salesforce, down 3.2, 3.25% today. Costco, 2.5%. CME, I covered that one, up 3%. Flowers Foods, I covered that one, up 3%. McCormick, I covered that one, up 4%. So you kind of see what's going on here. Lam Research, that's semiconductors, that's growth, that's down big, right? Parker Hannifin, covered that one. So the reason that Hershey is so attractive was one, valuation, two, the value aspect of the stock versus the growth. In fact, I even mentioned here this company has demonstrated a tendency to outperform the broader market during bearish times, indicating a margin of safety at this stage in the bull cycle. Okay, so how has that played out? Okay, we see here over the last year, it has underperformed. But what about year to date? This company's done well, up 12% year to date. Obviously, it had sold off significantly and is now in the green. Let's take a look at the last month. That's a 30-point spread between this company and the S&P 500. Notably, again, let's talk about today. We've got broader US equity markets in a fairly sharp single day drawdown, 2 to 3%. I mean, that's a big number. Meanwhile, this company is basically in the inverse with that same level of volatility. This is my vision when thinking about this company in the first place, is trying to identify a stock that will be green when the broader market is red. That's exactly what's happening. See this right here? Very clear inverse correlation. So you can see, again, it's not an exact science, folks, but you see how this stock, as of right this second, is trading as a counter cyclical name. And that's the foundation of my portfolio. Let's talk about some things. So I wrote my article and the stock was around here, 174, right? Shortly thereafter, there was takeover rumors by Mondelez. The stock shot up. This chart isn't even accurate because I remember it was over 200. The stock traded all the way down. Why did it trade down? Well, you had lots of things going on. You had Robert Kennedy Jr. He was going through the confirmation process as Secretary of Health or Health Services or whatever. This company is tied to him because of the way he's positioned himself as an enemy of big food. So you kind of had uncertainty there. But what's going on with this bounce? Okay, there's a couple things going on, I think. First off, they released earnings. Okay, they released earnings. You see here. Okay, that's the number one driver here, is that they released earnings. And guess what? When they released earnings, as expected, all of the worst news was priced in. All right, this company's been taking tons of black eyes. All right, between cocoa prices, the CEO has announced her impending retirement. Okay. But they released earnings. Lo and behold, people are still buying confectionery product. Also, you have the sector rotation. That's why I started the video talking about this. You have the sector rotation out of the NVIDIAs, the Broadcoms, the Googles, the high-flying tech stock names. There's a rotation into companies like the Hershey company. That's driving this. And then you have basically this being a non-factor so far. So that's been, I mean, you see here it's gone from, I think it bottomed, in the 140s to 190. It's up like 30%, up like 30% from a bottom. I did not buy any shares. throughout here because I wanted to see what earnings look like. Okay. Let's talk about earnings. Here's our earnings report. Again, this is more than a month ago. I'm a little late in making this video, but better late than never. Okay. So let's talk about this. Fourth quarter 2024, very important. This is the fourth quarter ending December 31st, 2024. There is a 5-week lag in these numbers. Okay. Consolidated net sales 2.9 billion, increase of 9%. That's year over year. Okay. That's pretty good. Organic constant currency net sales increased 9%. The impact of acquisitions on net sales, 0.2 point benefit, 0.2%, 20 basis points. What acquisition did they make? They bought a candy company for 100 million. Reported net income of almost 800 million or 3.92 per share diluted, increase of 130%. Adjusted earnings per share 269, an increase of 33.2%. 2024 acquisition of Sour Strips. Okay, pretty good. Remember, our dividend per share is $1.37. Okay. So we're hovering just above a 50% payout ratio on that quarter. Full year, this is better. Okay. Better metric here. Consolidated of 11.2 billion, increase of 0.3, 0.4%. Constant currency, 20% increase of net income. Good. Adjusted earnings per share, slight decrease. Okay. Kind of a mixed bag. This is what's important. Okay. 2025 full year outlook. So this is what they guided to. They guided to 2% revenue growth. But earnings per share, they're saying that's going to decrease 30 to 40%. Meanwhile, Sour Strips acquisition is going to be approximate 30 basis point benefit to net sales growth. Just a small deal. Okay. So obviously in a vacuum, these numbers look bad right here. Okay. But clearly the market has reacted well. This is almost coinciding with the time frame of earnings a couple days prior. Markets really like these results, but this one is a good example. This seems to have it kept going down on just worse and worse news. Obviously, our high was 270. We're still 30% off from that. It basically went all the way down to one. I mean, that's that's like a 40% drawdown from the peak. I mean, the stock went down to a price that was last seen in 2021. Okay, and it's a bigger, more profitable company since then. But basically what ended up happening here is they released these numbers and they're like, yeah, it's going to be pretty bad, guys, but we're still doing okay. Again, if you think about this is full year. They're saying down high 40% from here, mid 30% from here. Okay. 10% of this is 94 cents times 3 is 280. Wait, 94 times 2 is 188. 272, 282. Our dividend is still well covered, okay, with these numbers, okay? That's not why the stock is trading up, but if you're investing in this somewhat, I mean, this is kind of somewhat of the thesis for me. If you're trying to park money in a value priced asset that you're going to, scrape some yield off of, these earnings confirmed that you're going to get paid your coupon. We saw here at one point the stock traded all the way almost, it was 3.76%, almost a 4% dividend yield, and in a sense come back below 3%, still far above our 10-year average. Okay. Our 10-year average being mid 2%. So basically what happened was you just have all this bearish sentiment. And I haven't even started talking about cocoa prices. Let's talk about cocoa prices. This is another factor here that I forgot to mention, which was dumb. Another factor that I forgot to mention here, we see this is really the extent of the chart going back to June 2021. So this is driving a lot of the stock price as well. Part of my thesis again is that cocoa prices and all commodity prices, they do revert to the mean. Okay, simple supply and demand. There's been a huge supply shock to the cocoa price. Swollen shoot virus in West Africa, um, decimating the populations of these the cocoa beans, um, driving down the supply and ratcheting the price. There's some financial speculation involved in this movement. It kind of came back down to earth again, traded to a new all-time high. But we see here, this right here is the week of Hershey earnings right here. You see the date here at the bottom, right, in this region. Okay, so between this candlestick, and this candlestick is where we had our Hershey earnings. Our cocoa price was above 10,000 a ton, and it has come down about 15%. It's still up almost 4x from the more normalized baseline of 22,000, 2,200 a ton here. So we're not out of the woods yet, folks, but I think it's pretty clear to see that it doesn't take a genius to know that our stock price here is going to be somewhat inversely correlated to cocoa futures. Okay, so we've just had a lot of things go right for this company since they released earnings. But is it a good investment right now? I think so. I still think it's at a good valuation. Let's go back to our quarterly results. So this is our earnings per share, right? A diluted and adjusted. The biggest adjustment being that these business realignment activities, they actually made money on their cocoa hedging here in 2024. Okay. Notice how they're not guiding for that. That's a big wild card. Okay. But we see here that they're saying we're going to go from. I'm going to put my calculator here. I don't know if you can see this calculator, but hopefully you can. $6 divided by 190. 190 divided by 6. So there's your earnings multiple, folks. 31.666667, or 32 times earnings is what the company is trading at. Now, when the company was $140 a share, 23 times earnings. So we've seen significant multiple expansion in this. So here's the deal. My thesis is intact. I like this company. Okay. I still like it. It's one of the biggest positions in my portfolio, and it has materially contributed to the outperformance of my portfolio in the last several months. However, there's still a lot of risk, of course, in the acquisition of the shares. And here's what we've learned. Okay, what we've learned is that hindsight is 2020, but the real time to accumulate shares is when the sheer fear-inducing depths of this stock. This guy here, Eugenio Catone. Sorry if that's a mispronunciation, by the way. He got it great February 10th, right? It's up 23%. So, do I think that it's a strong buy right here? But we're in different territory here on the chart. So, from a fundamental perspective, I like the company. I think the price it's at now is okay. Okay. But here's the problem with where the price is at. It has gone up a lot. It has actually traded up through this floor here. There was a floor in the low 180s. We broke above that. The next stop is 200. I would say that this stock could keep going all the way to 200 just from a momentum technical standpoint. Here's the issue though. It's expensive. You see that valuation, expensive because of profit challenges, significantly contracting profits. Another thing that's problematic here is the cocoa price. It guys, the cocoa price still has not really impacted the earnings of this company. Um, you have a significant lag in the amount of time that the commodity prices make their way, trickle through the system and demonstrate themselves in the form of profits. And the reason for that is because companies like this purchase their cocoa using derivatives markets. So they lock in prices out into the future. And whether they take delivery or not, right, they hedge their exposure somewhat by buying product now that they use a year from now or whatever. So you think about that. While the stock price is correlated with the cocoa price, the underlying business performance is much more laggy. In other words, cocoa trades up, the stock price might trade down on the same day, but the business results, the underlying business performance, cocoa won't find its way into that for a while. Okay, and that's important. So again, the thesis that I have is still intact. I think owning this company is a good. It's been a safe haven. It's been a safe haven versus other U.S. equities because it's at this value price. Would I feel comfortable buying it where it is now if I didn't have a position? Yeah, I would, because I like the name. I like the way it's performed. Again, when I looked at this stock in November, a big driver of my thesis. Here, you see here in this bear market in 2022, the S&P traded down, whereas Hershey hit new all-time highs. Okay. So that inverse correlation was so attractive to me here, and it's been that way. So I'm perfectly content to hold my shares. Do I think it's a strong buy at the current price? Um, I don't know. I don't know. I really hesitate to grade it that way because there is a ton of uncertainty. I think a lot of the uncertainty has been hammered out. They're saying, yeah, investors, it's bad. This is what it looks like. We're going to do better. You have the CEO retiring. She's been a good CEO. They've invested into salty snacks. Let's talk about the breakdown here. Component of net sales growth. This is important, folks. Salty snacks have not performed well the last few quarters. So we could be seeing these good numbers looking a bit of a reversion to the mean. However, 36% growth in salty snacks versus a 6% growth in confectionery. This is what I'm really bullish on with this company is the salty snacks. Particularly again, when we're talking about salty snacks, what we're really referring to is Skinny Pop and Dots pretzels. Okay, so these are products that I do consume fairly regularly. I like the products, particularly the Dots pretzels. They're not the healthiest products, okay, but here's what's interesting. You see here with the confectionery products, okay, they were able to push price and volume on confectionery products. That is indicative of their moaty position in this market. Again, market leader in confectionery. Salty snacks, they actually lowered prices and saw big increase in volumes. They're trying to get market share. And this is not correlated to the cocoa price. I like what management is doing here because they're saying, you know what? The more we untether our stock performance from cocoa prices, the the more our shares will be worth in an uncertain commodity environment. So this to me looks like smart management, and this is what I wanted to see is lots of growth in salty snacks. That's the key to the future with this company. Okay, so now let's get to the last point, which is the CEO retiring. That's just a wild card. I don't really know what to say about that one. Okay, because Michelle Buck has been the CEO since 2017, I believe. Um, so, um, pretty good price performance since then, almost 300%, now about 200%. Um, so I'm really hoping that they bring in a CEO that um, is positive for the price, but that's just not something you can speculate on. So um, I am giving this a hold right now. It has gravitated up, from the buy. I'm very pleased with the performance that it's demonstrated and feel very confident holding my shares. However, I've got to ride this out. I've got to ride out the continue to see downward pressure on the cocoa price, continue to see volume gains in salty snacks. Um, I want them to ride out the challenges in the business. I've seen a lot of articles, a lot of information where investors are loving the dividend growth, and they're saying, "Oh, it's the dividend has grown 12% compound annual over the last 5 years." Well, folks, we're not in a regime of that right now when it comes to this stock. I would expect if they do raise the dividend to keep their streak alive. Again, let's take a look. They've paid 5 straight quarters after they raised it after 2. So they have one more quarter to go of another $1.37. If they raise the dividend, it's purely to keep their streak alive of raises. We might see a 1% increase. You will not see this stock increase dividends at a rate exceeding inflation over the next 2 to 3 years. That's my prediction. If you're comfortable with that, and you think this stock is a good place to hide in a more bearish market scenario like me, then you feel comfortable maybe picking up some shares. Again, I've got a significant for my portfolio allocation. It's like 6 or 7% of my entire portfolio in this stock. Um, that's played out really well the last few months, even with this big drawdown here. It's played out really well. So for people who already have a position, I would like myself, I'm holding shares. I'm not really buying. I am buying some shares here and there in my 1-year-old daughter's account because this is perfect stock for a kid. All right, I have bought a few shares here and there, but in our large account, no, we're not buying shares. We're holding on to what we have, and um, if anything, the earnings reinforced the thesis in the stock. However, yeah, I think it's not out of the woods. You still have a significantly elevated cocoa price. That's going to start to impact business results eventually. If the company continues to grow market share in salty snacks, that will soften the blow somewhat. Macroeconomics are reinforcing the stock price right now, and I am a macro themed trader. So I like the name. I like the relative safety that it provides. But yeah, the strong buy period would have been right after earnings on that. So um, yeah, I mean, we see technically, let's just draw, right? I mean, it just went all willy nilly. So from a technical perspective, like I was saying, there's maybe some further upside if you're just trying to trade momentum. Um, you're probably interested in this one again. For long term buy and hold, I feel comfortable here. Me personally, though, this stock is a hold. I'm sure that there was a lot that I should have covered that I did not. However, if you want me to talk about other things, please comment below. Please give me more things to look at. I haven't made a video in over a month. I'm trying to kind of cycle through a lot of what I've already covered and cover it again. We've had stocks release earnings reports and whatnot. I'm also working on a a side project aside from this that I will be making content about. I'm not going to share that yet, but I'm excited for that to come into the fray as well. Continue to drive growth. Please be sure to like and subscribe to my channel so you get updates about when I cover more companies. And I will see you next time. All right. Thank you for watching. Bye.